I've applied for mortgages in the past from an investment property perspective, and I'm looking to buy my first home with my partner next year. I understand for most there are a few uncertainties when it comes to the finance do's and don'ts during this process, so from the knowledge and research I've done, I wanted to collate and share a few of these with you. The first on that list is that you need to get a clear understanding of your finances from a budgets, savings and expenses point of view. And there are many reasons why you need to do this. Firstly, that you need to get a mortgage in principle. A mortgage in principle helps you understand how much money you'll be able to borrow before you actually go and apply for your mortgage. You'll need this to help you narrow down a search that actually fits within your budget, not when you get carried away looking at £10 million houses on Rightmove. Next, you need to have a good, clear understanding of your finances to ensure that you have enough money to save for a deposit. Most mortgages will be done via a 10% deposit of the total house price. So let's say a £200,000 house, you're most likely going to need a £20,000 deposit. But some mortgages you can actually do on a lower deposit amount, such as a 5 or even a 0% deposit in some cases, but most likely the interest that you'll be paying on those mortgages will be that little bit higher. And finally, you need to know how much money is actually leaving your account from an expenses point of view. This can be current travel costs, rent, car payments, gym memberships. Work out your total expenses and minus that from your total take-home pay each month, and this will leave you with a rough idea of how much money is left in your bank account as disposable income. And then you'll have a clear understanding of what will actually be left in your bank account again if you take on a mortgage and additional bills. When it does come to rents and travel, if you are buying a house and you're buying a house closer to work, then yes, you can eliminate the travel costs that you might have. And likewise, if your rent is going to be roughly the same as a mortgage, then yes, you can eliminate that too. And to get a good, clear idea of how much your mortgage is actually going to be costing you each month, you can use Rightmove's free monthly mortgage calculator. Such as this house here at £200,000, your monthly mortgage cost is going to be roughly about £1,000 per month. The second don't is that you need to make sure you do not take out any finance during or shortly before your mortgage application. Applying for loans during or shortly before can be a massive damager to your overall mortgage application and can even throw off some lenders from offering you finance. Some of the reasons linked to this is that it will lower your credit score, increases your debt to income ratio, and can lower your mortgage affordability. Even in some cases, applying for these loans will reduce your access to more favourable lending rates, meaning that if you do, you'll end up having to pay even more interest on your mortgage. Types of loans that could be included in this could be new car finance, personal loans, payday loans, going into your overdrafts, or even getting a new mobile phone contract. So you do need to be careful during or shortly before the application process that you are not taking on any additional loans. As an online mortgage advisor mentions, you do not need to be debt-free to get a mortgage. In fact, most homeowners actually have other types of financing when applying for a mortgage. The only issue is that if you apply for it shortly before or during the process. The other part of it when it comes to financing, mortgage lenders will be looking out for is if you've applied for multiple forms of credit in short periods of time, you have taken out lines of credit shortly before your application, your monthly debt repayments total a significant amount of your income, and if you are missing or you are late with your repayments. All of which will lower your credit score, which leads us on to the next point. The next do is to check your credit score and keep it as high as possible. There are 3 main reference agencies in the UK. Each collects information about you from public records, lenders, and other service providers. And these agencies then use this information to create a credit score for you. This credit score number indicates how likely you are to repay any loans that you have, mostly based around your past history of using credit and managing your overall finances. The higher the credit score, the more likely you are to be accepted for credit because it shows lenders that you're a safe bet. However, these scores are not set in stone and most likely will differ amongst all 3 of the agencies, and a lot of the time will change over the period of your life as well. But some of the best ways that Lloyd says to increase your credit score or to keep it high are having a mix of credit accounts showing that you can manage multiple different types of borrowing, being on the electoral roll, having no court records such as defaults, CCJs or bankruptcies, ensuring you're not carrying loads of debt, or when you do take on debt that you're not maxing out or near maxing out of your credit limit. Having a good length of credit accounts, so if you're opening accounts at 18 and you've still got them at 24, 25 years old, showing that you can still maintain those accounts over that long period of time. And finally, managing your accounts well, meaning no late payments, no missed payments, and definitely not going over your credit limit with these accounts. The fourth do or do not is do not switch your job shortly before or during the application. Switching jobs or having a major career change shortly before or during your application may throw your lender off or even hurt your chances of actually getting approved for a mortgage. Lenders want to see you as a safe person to give their money to, somebody that will be able to repay this money back with no hassle at all. So switching jobs during this process, they might see you as being unpredictable, as you could be on a probationary period with work and this income isn't guaranteed, meaning that if they do give you a mortgage, how likely are you actually going to be able to repay this? So the risk element for them is massively increased. You may also notice this if you are a temporary worker, if you're on a contract, if you're self-employed, because this work isn't necessarily guaranteed and you're not on a set salary and you know that the money's going to come in every single month. Lenders might see this as you being a little bit more risky, and therefore some, but not all lenders, might actually refuse your application. And then the fifth and final do or do not is do add extras to your deposit. This is one I kind of knew about before making this video, but didn't know to the full extent of it until reading an article from moneysavingexpert.com. They released an article saying that adding an extra £100 to your deposit can not only increase the chances of you getting a mortgage, but actually increase the chances of you getting more favourable mortgage rates. It's well known that mortgages get cheaper the lower loan to value that you have. So if you're buying a house with a 10% deposit and loaning 90% the rest of the value of the house, compared to if you're putting a 20% deposit down and loaning out 80% of the house, the mortgage rates and the interest rates that you'll get on the 20% deposit are most likely going to be cheaper than those on the 10%. Not just purely from a repayment point of view, but actually the pure interest rate itself. So in some circumstances where as a pair or on your own you might have 19% deposit saved up, actually stretching from 19 to 20% can make a massive difference. For example, on this comparison site using NatWest mortgages, you would end up with 0.02% better interest rates going from £39,000 deposit up to £40,000, which is 20%. Which I suppose to most, 0.02% doesn't really sound like anything to scream or shout home about. However, if we look at this from what it actually means from a savings perspective, it makes a lot of difference. So that 0.02% essentially equates to £400 saving per year, which once again doesn't sound massive, but if you zoom out over a 25-year mortgage term, that's £10,000 of money saved from 0.02%. So just think, houses are even more expensive than this, that could be 2-3 times the amount. Just think how much money you'd be able to save just by increasing your deposit by £1,000. So if you can, I would always suggest doing so. So to wrap up, we have some financial do's and don'ts when applying for a mortgage. Hopefully there's a few pointers in there that will help you out during your process. And let me know in the comments below if you have any more tips and tricks during the application that can help some other people out as well. And I hope you enjoyed the video, and I'll see you next week for a new one.